Our next guest says we are still in the most hated bull market in history, and that's actually good news for investors. Eddie Ghabour is the co-founder and managing partner at Key Advisors Group, also the author of The Common Sense Bull. So let's talk about the market. We saw Bank of America out this morning with its fund manager survey, essentially confirming your idea that people hate this market. We see flows out, we see positioning at a 2-year low, but yet the market is now within shouting distance of an all-time high. And I think that right now, to me, I look at the charts and I say things are fine. What's your look at this setup?
I agree. And this bearish outlook and all the bears that continue to come out and hate this market continues to support the bull market thesis. So I love it when we see this much bearishness. Like the fourth quarter, all the bears came back out again saying that here we go again, 2008. But my argument the whole time, the last 5 years, and I've been debating these bears, is the fundamentals are completely different. We have low rates, we have a growing economy, the labor market's strong, and we're seeing the highest wage growth that we've seen in 10 years.
So to go back to the fourth quarter, what do you make of that event? I mean, why do you think we saw a sell-off like that? I mean, essentially at this point, it feels like the standard state narrative is that we had a lack of liquidity. A lot of people were forced to sell everything really up to that Christmas Eve event. Do you think it was that, or was it just people got so excited about confirming their priors that they wanted this to be the one, and ultimately it was just kind of a blip on the radar?
It was all about the Fed in the fourth quarter. Okay, the yield curve started to tighten, and they were worried about one more rate hike and putting us into an inverted yield curve. The 2 and the 10 inverting generally means we're about 13 to 16 months away from a recession. So that's what was spooking the markets, and as soon as the Fed blinked and became dovish again, off to the races. And I think the Fed is off the table for 2019. I think worst case we see one rate hike in the second half of this year.
Eddie, going through your notes here, one thing that stuck out to me, you said that if we get a China deal and if the 10-year stays below 3%, you believe we'll hit new highs this year. How big of a momentum to the upside are you seeing if that happens?
So if that happens, I think, so I came into the year predicting that I thought we would see a 12% move on the S&P after the fourth quarter sell-off, and I think we've surpassed that already. So I think you can easily see another 5 to 6% on the upside in the market if we see this happen.
So earlier, I was actually listening to an analyst who said, look, you know, U.S. equities right now aren't so attractive. Doesn't seem to that's your take. One, talk to me a little bit about that disagreement, and if you think there needs to be a reallocation, and if so, where? Perhaps emerging markets or other international markets?
Well, I actually like emerging markets, and from the standpoint and we're talking about trade, I think if we get a trade deal, you could see higher upside internationally and in the emerging markets, because keep in mind, they've actually sold off a lot worse because of this. Trade has hurt international markets more than it's hurt the domestic markets. So if we get a trade deal, I agree. Obviously, there's more risk in the emerging markets, but I think there's tremendous upside more in emerging markets than U.S., only because they have a long ways to go to the upside.
Now, when you look at the market more broadly, you mentioned that 5-year time frame. We've had a few people through here who said we really didn't start the bull market until 2013. We finally broke out to new highs. I mean, is that the way that you're seeing this current run, that it's not from that March 09 low, you know, that we're a decade past now, but really it's from the first moment we made a new all-time high, and so we are at the beginning of a much more extended run than people say, because you so often hear, well, late innings, right? It's got to be. It's been 10 years, but has it really been 10 years?
Well, here's the thing. When you ask the bears why they are bearish, they'll say, well, it's been too long since we've had a major drop. Well, bull markets don't die of old age, okay? Something has to fundamentally break down. So you can't just say bear market without any fundamental support. So until the fundamentals change from an interest rate standpoint, from an economic standpoint, and growth is still there, I will continue to be bullish. There have been times, like in October, when I got a little bit bearish because there was too much complacency in the market. And then after the big sell-off in the fourth quarter, it was off to the races and we were bullish. And
so you're not worried about that 0% earnings growth we're probably going to print for the first quarter. You're not worried about potential downward revisions to earnings for the rest of this year, because they've already been pretty sharp. And I think the outlooks for earnings would seem to be skewed to the downside, especially given the backdrop in Europe and China.
Yeah, well, the good thing with that is they're pricing in, there's not a high expectation for earnings, right? Everyone's expecting this earnings recession to head into. And I think with the damage that was done in the fourth quarter, because there was a lot of damage done to the market, that the second half of this year, with rates being where it is, that earnings may actually exceed expectations.
So, Eddie, where are you putting your money right now? Where are you seeing some opportunity? I know you said emerging markets. look attractive. But once we drill down, we've seen leadership from a lot of the cyclical names. Tech has been very strong so far this year. Do you expect that to continue?
Tech still, tech has held up really well. When you look at the Googles and the Amazons, we've had some pretty volatile days, and those stocks have held up fairly well. You wouldn't normally think that because they're normally very high volatility. So I still like those, and I actually came into the year, I'm a contrarian, so I like the big banks coming into the year. The Cities and the Bank of Americas, they have basically underperformed a lot of indexes, and they've had a pretty good start to the year. I would expect short term to see a breather here for the market until, again, we get some clarity in regards to China.
All right, Eddie Ghabour, Key Advisors, thanks for stopping by.
Thank you for having me.
Thank you.